Lisa Nations, we're going to ask you to put up your presentation, and Lisa will be talking to an option for how we're going to pay for all this emergency work in our uncertain times. Thanks.
Thank you, Chris. Thank you, Joe, for that very interesting presentation. Thank you, Peter and the Rock Blue team for inviting us to be a part of this lecture series. I'm Lisa Nations, and I'm joined today by my colleague, Shannon Riley. To begin, we'd just like to say that we hope everyone is staying safe and healthy. We wanted to thank and acknowledge the work done by our colleagues at the utilities. We know that water, hand washing specifically, is one of the most important preventative measures at this time, particularly in contexts where social distancing is not possible. So our colleagues running the utilities deserve a lot of credit, and we thank you for your continued public service in the face of COVID-19 risks and implications. Just a quick reminder, as Chris mentioned, the slides that we will now present will be shared with everyone at the end of this presentation. So just to begin with a little context, as many of you are intimately familiar, utilities have already seen reductions in cash flow caused by COVID-19. Rock Blue has seen indications that cash collections could have decreased by 30 to 70% in the first few weeks of the pandemic. And utilities won't want to, and most governments won't let them disconnect customers during the pandemic. So a key payment enforcement mechanism is not available to them. At the same time, utilities are seeing increased costs due to required investments in PPE, workplace adjustments, and government mandated obligations. So this is causing water utilities to be more cash strapped than usual. Unfortunately, the same situation is largely true for governments. So the economic downturn means lower tax receipts for governments, while at the same time, the fiscal demand for health and social spending have increased. So governments will likely come out of this pandemic in a much worse fiscal position. And then finally, we think that donors will lend more in total, but it may not be adequate for all of the infrastructure stimulus needed, or it may not go to water in adequate amounts. So the bottom line is essentially that water utilities urgently need a source of finance. So what we will now present are two viable options that we are thinking about in response to this urgent need for cash. But please bear in mind, these are not the only options out there, and we're not advocating that these are the only two solutions. So the first option is a financing facility. And this is something that an idea that we've been working on a lot with friends and development partners to really flesh out this idea. We believe that a financing facility is a good way to provide finance needed to utilities at such a large scale. And this could work well because it can facilitate rapid disbursement of cash, and it can cater to the local context, for example, the local fiscal position. The second option that we're excited about are non-revenue water performance-based contracts, or NRW-PBCs. And this is because they provide innovative financing for projects that will both help water supply and provide an economic stimulus. So part of the economic response to this will be a stimulus package, and we think it's a good idea to have, as part of this fiscal stimulus, infrastructure spending, because that can create work and the community gets something of long-term value. So first, I will go through options and considerations in the design of a financing facility, and then I will hand it over to Shannon to explain how NRW-PBCs can be privately financed and how that can provide a viable solution in the context of this pandemic. So just to begin, to explain the concept of what we mean by a financing facility. So you see on the left-hand side, it first starts with finding sources of finance because the money needs to come from somewhere. And then once you have the money secured from a source, it will flow into the facility. And then from the facility, the money can then be dispersed on to utilities. We think a facility is a good idea because countries tend to have many water utilities because, as you all know, water is a local service with local providers. So one entity, being the facility, that deals with all of the utilities is a good idea. However, in countries where there's just one national water utility, it will likely be unnecessary overhead to create this facility, and it may be quicker for them just to loan directly or to disperse cash to the utility directly. So now I'm going to go through options and the considerations on the design of this facility. Please keep in mind that the detailed design of the facility is not prescribed here, because that really needs to be done at a local level. So first, starting off with estimating the scale of support required. So in terms of required financing in the face of this pandemic, there are 4 general categories, and these are planning, addressing the initial peak, addressing subsequent waves, and longer-term resilience planning. So what this facility is designed to do is to address the second and third categories, being the initial peak and subsequent waves, and potentially also the 4th category of longer-term resilience planning, depending on the design of the facility chosen. So you need to start by estimating the scale of support required. So the World Bank has actually developed a simple financial model for estimating what the impact of this pandemic is on utility finances. So that's one good way to estimate it, but regardless, it needs to be done at a macro level first. And then the designer needs to consider, will there be conditions or restrictions placed on how much money each utility can get? So what you'll see on this slide, what this graph is showing is a couple things. So what we're showing here is the cash flows of a utility, very stylized, not based on any real utility, where the utility before COVID had cash flows of 100, and then when COVID hit, their cash flows dropped down to 50. And even before, what we're showing is a utility that was actually running a deficit even before COVID, because as you'll see from the navy blue dotted line, their cost recovery level was actually at 120. So now COVID hits and their cash flows are reduced to 50. So how much money should this utility get? There are a few options. The first option you'll see is represented by the gray line, and so that is to provide money equal to the reduction in cash flow caused by the pandemic, or in this case, $50. The second option is the navy blue steeped line, and that is to set the amount equal to the funds needed to keep operating regardless of cause. So utilities with pre-existing deficits, like the one in this graph, could have those covered by facilities, whereas water utilities that were in a strong cash flow position before the pandemic would be expected to absorb some of that impact using their pre-existing surplus. So in the graph, that would be a disbursement of 120 to get them up to cost recovery levels. This option, the advantage of this option is that it ensures that utilities have continuity of service, but the disadvantage could be that calculations could be more complex and controversial than those under the first option, especially since it may mean covering inefficiencies that many utilities have. And then a third option is, in estimating the scale of support required, the designer of the facility also needs to consider whether or not they would like to use the facility cash disbursements to also promote reforms in the utilities. So the basic idea here would be that utilities would sign up to reform conditions in order to access 2 benefits. So the first phase would be funding, meaning quick dispersing emergency funds to keep the utility running. And then later phase would be additional financial assistance to implement the reform program. So that is what is being shown in this graph right here. That first phase is shown by the gray line. So that is the funding that would be quick dispersing and emergency funds to keep the utility running. And then the navy blue lines would be these later reform program disbursements. In order for a concept like this to work, the reform direction will have to be described with defined milestones that allow an objective judgment on whether they have been reached. So milestones will generally be of 2 types, actions and performance. So actions are things that the utility has to do. For example, installing a new billing system or implementing a non-revenue water reduction program. So in this graph, for example, the utility, for example, installed a new billing system, which would then make them eligible for their second disbursement, the first navy blue line. The second milestone could be performance. So these would be results that the utility has to achieve. These would typically be specified through a set of key performance indicators. For example, achieving a target coverage percentage. So in the graph, you see a utility achieves KPI 1. This could be the utility achieving that target coverage percentage, which then makes them eligible for their next wave of disbursement. So once you have the scale of support required estimated, you need to think about what sources of finance you're going to use to get money into the facility. So we think there are several options. It could be government reserves or tax receipts, national government commercial borrowing by the facility with a sovereign guarantee, multilateral and ODA resources, and concessional finance of national government. Of course, the source of finance selected will depend a lot on the availability of these options within the national context and the expected fiscal position of the government during and after the pandemic. So I'm just going to walk through a few of the considerations of each of these options. So where possible, governments can provide funds to the facility out of tax collections. However, as I mentioned earlier, with government revenue going down, the government may not be in a position to do this. So this may mean they're required to borrow more than they usually would be. And a point to note is that many of these sources of finance will actually need to be sourced through the Ministry of Finance, just because a lot of these sources have to go through the Ministry of Finance first. Where national government commercial borrowing is possible, this will likely be a good solution because it's quick and it's in the government control. But of course, this will only be possible where the national government is creditworthy or where they may have previously been creditworthy and they can be helped with an official credit enhancement. And what an official credit enhancement would do is it can enable access to commercial finance that would not otherwise be possible, and it may reduce borrowing costs. So that would be the second option. Where the fiscal situation has led the government to turn to multilateral or ODA resources, maybe loans from the IMF will be the quickest way to get money into the facility. There's also an option for financing from development banks, but these typically take longer to access. But of course, their advantage is that they may come with technical assistance, which could help with the design of the facility itself. Concessional finance is really desirable, but in many cases, there's only a fixed quantity available. So using it for the purpose of this facility may mean not using it for another purpose. And then finally, where possible, though not common, utilities could get commercial loans themselves. So then once the designer of the facility has decided on a source of finance, then they need to think about the modality of disbursement. And here we've identified a few options again. So it could be dispersed through a loan, through a grant, through a guarantee, through equity investment, or through some sort of hybrid model. So again, this will need to be decided based on the local conditions, but I'm just going to run through a few considerations for each of these options. So as we all know, this is a pandemic, it's a health crisis, it's urgent, there's not a lot of time available to spend agreeing on loan conditions and structures. So that's why there is a strong argument made to be for grants as the modality of disbursement. But just keep in mind when thinking about that, as shown previously, there's two steps of the flow of money in this facility arrangement. So if the national government is getting money for the facility as a loan, that's their source of finance, and then granting it onto utilities, the national government still has to repay the loans, which may be challenging when governments are further fiscally strained. So just something to keep in mind when thinking about dispersing this as grants. Loans, on the other hand, may reduce the fiscal impact problem, but it comes with a time burden. That being said, loans could work well because many water utilities can and do repay loans, and many more could repay loans if appropriate steps were taken to increase efficiency and charge cost-reflective tariffs. So this idea goes back to what we were talking about of pairing the facility disbursements with utility reforms. A guarantee, the next option, would be most applicable in situations where the utility already has access to commercial finance, but due to the impact on their cash flows caused by COVID, they're seen as too risky from a private finance perspective. So then the facility would guarantee the commercial loans received by the utility. Equity is probably less likely, but it is applicable if the water utility is already privately owned. And then finally, some sort of hybrid, and this could mean providing a grant for urgent funds plus a loan for additional funds, or a debt hybrid where the utility could get a loan from the facility and a loan direct from the commercial bank, or a debt equity hybrid where a loan could be converted to an equity investment in the event of non-payment. So just to summarize, I went into a bit of detail on what sources of finance might be available to get money into the facility, and then what modality might be used to get money from facility to utilities. But there's also a parallel option here that utilities, more so on their own in some instances, can quickly implement to improve their cash flows that Shannon will now talk about.
Thank you, Lisa. Hello, everyone. So now I'll explore in a bit more detail our second option for improving water utility cash flows amidst the COVID pandemic. Option 2 is a performance-based contract for non-revenue water reduction, or an NRW-PBC for short. This option is really attractive because it improves the water supply situation and the financial situation, allowing more water to be sold at a lower cost, both today and in the long term, making it also an attractive option for resiliency in water utilities. In addition, an NRW-PBC, being an infrastructure project, can also act as an economic stimulus project, which is something that governments are really looking for and very interested in the midst of what is not only a health crisis, but also really a financial crisis too. So this first slide here shows the basic structure of the NRW-PBC, which is an incentivized form of outsourcing technical and construction activities related to NRW reduction. And these activities could include larger initiatives such as mains replacement, as well as less capital intensive measures such as pressure control, active leak detection and repair, and on the commercial loss side, meter replacement and meter calibration and regularization of illegal connections. The contract would be signed between the utility and the NRW reduction contractor. And this arrangement allows the utility to take advantage of the expertise and the incentivized performance of a specialized private sector firm, while still retaining control of its operations and its assets. So unlike a full-fledged PPP, where the private operator may take control of the assets, full control, under this performance-based contract, the utility maintains that control. Being a performance-based contract, the contractor is paid for outputs achieved, which could be cubic meters per day of NRW reduction or similar metrics. And this is unlike a typical construction contract where the contractor would be paid just on the work they have done rather than the outputs achieved. And so this transfers more risk to the side of the contractor and helps ensure that the utility is really paying just for those benefits of NRW reduction that are actually achieved and measured. So, this slide goes into a bit more detail on the potential cash flow impact of an NRW-PBC. There are many utilities that are at the cusp of an operating surplus, meaning just now they operate at a deficit of a few percent. And just by reducing NRW and either earning more revenue through the sale of additional water or by reducing variable production costs, plus with related measures like collection efficiency improvement, utilities could move from an operating deficit to an operating surplus. And this distinction between deficit and surplus is really important because, as summarized at the bottom of the slide, a utility in a deficit can pretty quickly spiral into a state of worsening performance as the deficit causes it to reduce spending, so the assets deteriorate, service quality declines. That may lead the utility to then sell less water, which may exacerbate the cycle of the operating deficit. Whereas, on the contrary, a utility with even a small cash operating surplus, that small surplus can go a long way, as it means cash is available to improve service, to ensure assets are well maintained, to then sell more water, and maintain the virtuous cycle of the operating surplus. This NRW-PBC model has been used around the world. In Kuala Lumpur, a PBC was implemented in the 90s to avert a water crisis. In Brazil, dozens of PBCs have been implemented, especially on the commercial loss reduction side, in particular to ensure revenue recovery from large customers. And there's many other examples. This slide is just a brief summary. And in the interest of time, I won't go through all of the details, but the gist of it is that NRW-PBCs, can work in a lot of situations, from small jurisdictions like the Bahamas, which has just a few 100,000 people, to larger cities with millions of people like Bangkok, Ho Chi Minh City, and others. One thing about many of these past PBCs, though, is they've often involved a lot of public money, either direct support from donors or from the government. And, we know that public finance isn't always readily available in the large quantities the water sector needs in normal times. And this is especially true amidst the pandemic, where, government tax revenues may be going down, while at the same time, governments may be helping businesses in all sectors of the economy. So what we believe many utilities will be looking for, and many governments will welcome, is projects that can be fully or partially privately financed. And as this slide shows, NRW-PBCs seem to be a good candidate for that. They can have high IRRs, high internal rates of return, relatively short payback periods, and this is especially true in jurisdictions where the cost of water is relatively high, such as those jurisdictions that rely on desalinated water. So what this slide shows, this is some more stylized modeling. So it isn't a real-life utility, but what we've done is make assumptions about the level of physical loss reduction required, the level of commercial loss reduction required, and used standard, middle-of-the-road unit prices for NRW reduction, building off of actual examples of NRW-PBCs. And we've assumed a tariff of 60 US cents per cubic meter. And what this shows is this type of project under these conditions, the project IRR would be about 29%, so quite high, and the payback period relatively low at about 6 years. So that financial analysis shows that NRW-PBCs do seem to be attractive to be privately financed, and interviews and discussions we've had with NRW contractors and commercial banks and equity investors as well indicate the same, that it is an interesting project type. And what's also good is that the common project finance structure that is familiar in the sector for water treatment plants and other projects, that project finance structure can also work for NRW-PBCs, meaning, you know, an SPV is set up and all the cash flows work in that way. In situations where payment risk might be an issue, escrow accounts can be established, as shown here. So this would mean that, you know, customers' bill payments, instead of flowing directly to the utility, they're held first at a revenue escrow account at a commercial bank. This would be a third party managing that account, so not the utility or the contractor, but a third party. And, you know, the escrow account manager would be responsible for providing the performance-based payments that the NRW reduction contractor is entitled to directly to the SPV, and then providing the remainder of the money to the utility. And this structure, again, some of the NRW contractors and commercial banks that we've interviewed in the past for a number of projects, this type of arrangement is something that they're really interested in because it does help eliminate that payment risk. And so for those utilities interested in NRW-PBCs, the good news is there are a lot of templates and resources that already exist, both to design the PBCs as well as to procure them. So the World Bank has a resources page. The link is shown here at the bottom of this slide. And that resources page includes an operational manual, setting out the steps to take in setting up an NRW-PBC. It also includes sample TORs for procuring various technical and transaction advisory experts to assist with the PBC. And the website also includes standard procurement documents. And one really important thing to note is in the past, designing and procuring NRW-PBCs has taken quite a while, even years in many cases. But these days we're very optimistic that it could move much faster because these resources, especially the standard procurement documents, are already available. And both the standard procurement documents as well as other innovative contract options that we've been conceptualizing, where SPDs don't exist yet, but could soon. A lot of these don't require the use of a very detailed technical baseline because that's the step that usually takes the most time and can really slow down the NRW reduction effort. And finally, just kind of a brief overview of the competitive market of service providers that exist all over the world, from the Americas to Asia to Africa. And I'm sure there are others. This is not a fully complete list, but just an overview of some of the service providers out there that are entering into these NRW-PBCs. So in conclusion, utilities, to go back to what Lisa mentioned at the beginning, utilities are in a really tough spot right now with cash collections falling, OPEX and CAPEX increasing, and this is all in the context of a health crisis where people really rely on clean water for hand washing, as well as basic human needs, plus a financial crisis. That means governments may be less able to finance the sector than usual. Two options for overcoming this challenge, among many other options that could be viable. One is a financing facility, as Lisa explored, in which money from various sources is pooled into a facility and then dispersed to the utilities. Or secondly, an NRW-PBC, which is a way to improve water supply, improve finances, boost the economy, and also promote resilience of water utilities in the long term. So thank you very much. And now we'll move on to some more Q&A.